The title of our webinar today is Forgotten Gems, Small Tech, Big Value. I'm sure many of you have already been investing in equities. Often you would question if the valuation is too high and you should take your profits. And what are the next stock to buy? Some of you may have either none or very little exposure in equities today, and you would like to know if this is the right time to invest in equities, and what would be the areas to be in. Today, we at HSBC Private Banking has prepared for you this webinar, hoping to help you uncover some of the forgotten or hidden gems in the equity space. We are putting together a very strong team of investment professionals. It is our pleasure to bring you this strong team panel of 3 professionals. First, Mr. James Chiu, our Chief Market Strategist for Southeast Asia. I'm sure if you have joined our webinars in the past, James will be no stranger to you. James is also frequently featured on media like CNA, CNBC, and Bloomberg. He's our key strategist and will share with you a view on the macro picture, so the why, and as well as how to position the portfolio for equities. He will be our panel host. Our second investment professional is Mr. Pratik Ray, Head of Equities for Southeast Asia. Pratik has 20 years of experience in investment advisory, research, and institutional investments. Pratik covers a very wide range of equities, and his special focus is in property companies. He was ranked as the top analyst by the industry-wide pool. Our third investment professional is Mr. Alex Lin. Alex has 15 years of experience, and he has been advising high net worth clients. He also covers institutional clients in the past and monitored portfolio size of more than $2 billion. He covers a wide range of equities. Of course, he has a special focus in technology companies. We hope you will enjoy this webinar, and HSBC Private Banking can be the key partner of your choice for your equity investments. So without further delay, please allow me to pass the microphone and control to James Chiu, our Chief Market Strategist for Southeast Asia. Over to you, James.
Well, thank you, Sam, for your wonderful introduction and setting really the stage of what we are going to talk about, raising key questions about finding forgotten gems, whether it's through small tech or whether it's through big value. I think first up, we have to understand what the post-COVID-19 world look like. And in my mind, if we can go to the next slide, the post-COVID-19 world is going to be splintered into 3 parallel worlds of sorts. First is going to be one that is more indebted. And also, at the same time, what it means is that the world is also going to be much, much more connected. Today, we are all connected through Zoom. It's a testament to being a more digital and connected world. But also at the same time, despite being a more connected world, we are going to be also in a much more divided world, which means that there's going to be much more uncertainty, whether it's market uncertainty or even economic or geopolitical uncertainty. If we can go quickly to the next slide, I want to elaborate more about what I mean by a more indebted world. Because in the next 1 to 2 years, growth is going to be extremely anemic. And that the biggest spender that we're going to have is going to be government. Government will be the biggest spender in the next 1 to 2 years, but it will result in higher debt by government. And in order for government to finance all these debts, they have to borrow, they have to fund it through QE or quantitative easing, which is the printing of money to finance this huge amount of debt that has already been on their balance sheet, and it's only going to increase. And the scale of that sort of QE that we're going to see is unprecedented. Over the last couple of months, we've seen more than $3 trillion of QE that is being enacted, and that's equivalent to QE 1, 2, and 3 combined that was done after the great financial crisis. So this global pandemic means that QE is going to be much more prevalent, and more importantly, it means that we're going to be stuck in a zero-bound interest rate environment for much longer than we would like. And I think that's very clear since last week, especially when the Federal Reserve shifted their policy strategy from one that's targeting inflation to one that's average inflation targeting, which means that they will allow inflation to run hot for a while before even raising interest rates. So in an environment that we're going to be in, it's going to be low interest rates or even zero interest rates, and that QE will still continue. Very quickly, if I can touch on the next slide. What it means is that we're going to be a more connected world. And if we go to the next slide, it will create many interesting opportunities. We are connected through Zoom right now, but it's only at the tip of the iceberg. Because in many ways, Zoom is great, but a lot of the interactions that we have through Zoom, it's still very much two-dimensional. It can be improved, and it will be improved to make the experience much more engaging, much more interesting through three-dimensional manners. If you look at the next slide, and that there will be much more employment and use of augmented and virtual reality. So I believe in a post-COVID-19 world, there will be much more improvements in this technology in which virtual and augmented reality will become a reality. And that's going to create many interesting investment opportunities as well. Next slide. So I think we have established that we're going to be in a more digitally connected world, but also we are going to be in many ways a more divided world. And if we see the next slide, US political elections is going to be one risk that could create some market volatility. And of course, regardless of who is going to be the president, one thing for sure, and it's clear, is that both president, whoever that's elected, will likely be very much still anti-trade, anti-globalization, anti-China. And that's going to create a lot of market volatility that we've seen over the last 2 to 3 years. And that would persist regardless of who becomes president. But nevertheless, it will also create many interesting investment opportunities in the years ahead. If we look at the next slide, one of the trends that we're going to have is that despite this sort of uncertainty, there's going to be a trend towards robotics and automation. One of the reasons is that COVID-19 has accelerated this trend because of social distancing, and you're going to see robots being employed, not just in the factories, but also in our everyday lives, because robots don't spread virus. And I think in many ways, they are going to be much more efficient. And that's going to be a very exciting investment team in the years ahead. And of course, if we look at the next slide, one of the focus of US-China tensions is that as these tensions escalate, what it will force China is to look within itself and improve its own technological skills and its own technological prowess. And I think that's already happening right now. The Chinese are accelerating their 5G adoption. Currently, almost more than 10,000 5G base stations are being built every other week. And I think they want to reach 150 million 5G users by the end of this year, which is incredible. And the powerful thing about 5G is what 5G enables. 5G will enable smart cities, automation, it will enable smart factories, it will enable autonomous driving in many ways because 5G reduces lagging or latency. So I think 5G is going to be a very powerful team, a very exciting investment team in the years ahead. So if I were to skip one or two more slides, if we skip this slide, and I want to summarize why this whole equity rally has been so strong. One of the reasons primarily I touch about is because of a more indebted world. And in a more indebted world, what it means is that central banks will reduce interest rates or keep interest rates extremely low. And one of the powerful factors in equity prices is because equity prices is essentially a discounted of future cash flows into the present value. And if interest rates fall or keep at a very low or zero level, it means that equity prices will be well supported. And that's really, to me, the key driver that has pushed equity prices much higher, together with the QE that I've talked about, the huge amount of liquidity that's in the market. And of course, with this huge amount of liquidity that's ongoing, swashing around in the market, it has to search for growth. And one of the areas that have growth, as I've talked about, is a more connected digital world. And a lot of the technology companies have growth in this anemic world growth environment. And because of that, a lot of the flows have flowed into the technological stocks, and therefore it has risen significantly. And therefore, I think for us at HSBC Private Banking, we have been overweight on equities since April and May. And of course, our overweights of US and China stock markets have gone beyond that. We have been consistently overweight there, and at the low of March, we went overweight on China, and those calls have proved to be correct. And in terms of sectors, we continue to like technology, and I think that will do well. But at this stage, it's going to be much more selective, given that prices have run up significantly. And I think with that, I would like to bring Pratik into the discussion. So I want to ask Pratik, where do you see equity market, and what's the basis of this whole equity market rally?
Well, thanks, James, for that introduction and dovetailing, me into the conversation. If we can just move one slide further down, we have some interesting, charts out there. So over there, what I've tried to do is I've tried to put down the shifts in consensus estimates, and I've tried to provide some color as to how the consensus earnings estimates have been evolving through the most recent season. So obviously, James, you mentioned about, the abundance of liquidity that is there in the market, but I think what we should not forget is that earnings generally have been coming in better than expectations that the street had set up for themselves. And if you look at past recessions, usually we've had earnings cuts over a 3 to 6 month period. And this time around, the earnings cuts sort of commenced in around March, which basically puts us right at the tail end of that earnings cuts. If we were to go back to history and take a look at how things have panned out in the past. And indeed, in the more recent results in certain markets like the US, as the charts, or the snapshots below on the bottom left and bottom right show, the earnings surprises have really been coming in a lot stronger than what the street would have anticipated. The bars there, both from an earnings perspective as well as a sales perspective. At the bottom right there, you can see the blue bars, that's the earnings beat. The orange bars, those are the sales beat for this last quarter, has been significantly more than what we've seen over the past 2 years or so. Furthermore, I mean, to address your point on liquidity, if you flip to the next slide, on the left, we've plotted the movement in the MSCI World Index, which, as we all know, in the white line there, as you can see, has recouped, pretty much all of the losses that they had registered during the March sell-off. But the interesting point to note, as you also alluded to earlier, James, is that the orange line, which is the Fed balance sheet, we've seen a massive expansion in that since March. And pretty much the equity index has moved in tandem with that expansion in the balance sheet. So I guess the key question for investors, is what should we do now, given that, these equity markets have gone up to where they are. And in that context, I want, everyone to focus on the chart that is there on the right. What we are telling clients is to adopt a three-pronged approach. Obviously, we've got structural growth in certain sectors, like the tech-oriented names, primarily in the US and in China, and some of the other sectors that might be out there associated with tech, like communication services and consumer discretionary. The second approach would be, look at laggards selectively. Given what's happened to the valuations for some of these structural growth opportunities, there is a case to be made, and I'll highlight in my subsequent slides, for selective laggards, which could give you exposure to a reopening of the various economies, and the fact that these laggards could be potential beneficiaries of that. The third strategy would be to look at dividend income. This would be largely in defensive sectors, from companies that can offer sustainable dividend yields, that have a track record of not cutting dividends, through the good and bad times, and companies that are operationally and financially strong. So with that, if you move to the next slide, I want to focus first on some of the, on the second, bit of that strategy, which is on the value side of things, selective laggards. And the one chart that I want to, highlight in this regard is this gap between growth and value. Obviously, there are very sound reasons why growth has outperformed value over the course of the last 10 years. As you can see from this chart here, the white line representing the MSCI World Growth Index and the orange line there representing the value index for MSCI World. But this gap in terms of performance has widened very significantly since the March sell-off. And that is the reason why we are saying that while it's not appropriate for us to completely get out of those structural growth stories, I think at the same time, we cannot abandon opportunities that might be there from a value perspective. Especially, we've noticed that during short spurts, value has indeed outperformed some of these structural growth ideas, and people have rotated in and out of value and into growth. With that, I wanted to highlight some ideas specifically where these opportunities might lie, and the subsequent slide provides us some color with regards to where we might be able to find these opportunities. So on the left side, I have plotted out the two usual valuation metrics that we use at a broad sector level. One is the price to book number, and we looked at it in relation with return on equity. And at the bottom on the left itself is the price to earnings ratio for 2021. Obviously, for 2020, it's a distorted year where earnings have been cut. There's been severe or significant revisions. So we wanted to look beyond the 2020 number and into 2021. So at the top left there on price to book versus ROE, you can see that two of the sectors which screen cheap on a relative basis are actually financials and real estate. And then on the bottom left chart, you can see that financials in the red bar, the next year PE number is one of the sectors which is trading fairly close to the 5-year historic average. Given the abundance of liquidity that we've seen that's been injected by the central banks, many of these sectors are now trading at levels which are higher than what we've seen over the last 5 years from a PE perspective. And then on the right side of that same slide, I have put down a chart with regards to what is the percentage of market capitalization for some of these sectors. So you can see on the chart there in blue, the percentage of representation in terms of technology stocks in the US market, that has now reached levels that we saw during the dot-com period, or just pre the 2000 dot-com crash. And conversely, at the other end of the spectrum, reflecting some of the value ideas, you can see financials as a sector. Pre-GFC, we were about 20% of the index on the US. Now we are about 10%. So clearly, the data points on the left are also being reflected in terms of market capitalization and proportion of market capitalization in a big market like the US on the right-hand side chart. So with that, I wanted to go into some specific ideas, and given that financials and real estate have been the key areas to focus on, those are the two areas that investors can look at.
Yeah, Prasik, well, thanks for your insights. I think you make a very interesting observation that, and you mentioned financials as a sector that you can find value. So if you want to discuss, could you speak a bit more on the specific stocks within the financial sector? And of course, the headwinds of banks being forced to cut dividends. Is it still a sector that's worthy of investments, given that there's regulatory pressure on that front? So it would be great for your insights to talk about some actionable bank stock ideas.
Yes, thanks, James. I think, so we have the first, name out there already. So someone clearly read my mind, and, we've got JP Morgan, clearly the largest bank in the US, one of the best positioned in terms of being ready for a recovery in terms of sentiment around COVID-19 issues. The stock, as you can see from the chart here, has sold off 30% from the highs that were made in the earlier part of this year. As we've seen with most of the banks, not only in the US, but generally across the world, investment banking, capital markets activity has really been the area that has surprised the street, whereas things like your net interest income, that has been fairly, it's been fairly well articulated by the banks as well as the street that those numbers will be weak. So the softness that we've seen on the net interest income side has been offset by this capital market activity. Management has already taken huge provisions, and in this regard, JP Morgan has been one of the more conservative banks. In the first and second quarter, they've brought up the reserve buffer to about 34 billion, which is the highest levels that we've seen since the global financial crisis, at about 3.4% of their total loans. The CET1 ratio, which is the key measure of the strength of the bank's balance sheet, stands at 12.4%. And at that level, the bank is fairly confident of maintaining the dividends that they have been paying at about 90 cents per share, which translates into 3.6% sort of dividend yield, even after all the turmoil that we have seen. On a price-to-book metric, as I mentioned earlier, one of the key measures for banks, we continue to trade at below the levels that we've seen over the last 5 years. Another stock that I want to talk about, very similar in profile to JP Morgan, but slightly, at the riskier end of things, if you're looking for something that is cheaper, is Citigroup. Again, leveraged to the recovery in the US around the COVID-19 issues, as well as, globally. The stock is off 40% from the peak that was registered in the early part of this year. From a price to book multiple perspective, this is trading at about 0.6 times book. So a lot cheaper on that metric from JP Morgan, albeit the risk associated with the stock is higher given their more international exposure. Again, like JP Morgan, they've taken huge provisions in the first and second quarter. The reserve buffer is about 26 billion at close to 4% of loans, and the dividend yield is at 4% with a CET1 ratio of about 11.5. That would be a riskier second idea that we would have for investors, specifically looking at playing the global recovery around COVID-19. More locally, I think here in Singapore, amongst the banks here, DBS is an interesting opportunity in our view. The stock's trading about 22% of the highs that were registered in the late part of 2019. Again, like the other two names that I've mentioned, management has been able to deliver a better set of numbers relative to peers, both from a net interest income as well as non-interest income perspective. They have the strongest CASA balance amongst the local banks here, and from a risk perspective, their exposure to the SME loans or the loans that are under moratorium is amongst the lowest amongst the three local banks here. From a dividend perspective, obviously, as we all know, MAS has instructed the banks to relook at their dividends, and indeed, all the three local banks have cut their dividends. But even after that cut, you're looking at a dividend yield of north of 4% for DBS, and management has clearly stated that beyond the second quarter of 2021, if they are allowed to, they would actually move back that dividend number up. Similar to the rest of the other global peers and the two names that I mentioned, the stock continues to trade below its 5-year historic average from a price to book multiple perspective. So these would be the three key ideas that we think investors should look at from the banking side of things, leveraging themselves for an economic recovery around the COVID-19 issues.
Well, Pratik, thanks for your insights. And I think one sector that you mentioned is about real estate. Real estate is going to be fairly tricky because you have a low interest rate environment. Usually that's positive for real estate. But at the same time, we know how real estate has been affected by COVID-19, given office space, work from home arrangements and stuff like that. So can you share how is this an idea, a laggard, and how do you play the real estate in terms of actionable real estate stocks?
Yeah, so if you flip to the next slide, what we wanted to highlight is that even within the real estate space, there are stocks that have done extremely well. And the first example I want to take is within the REIT sector here in Singapore. So you have the entire REIT sector that is still down year to date, but within that REIT space, you have a handful of stocks, about 4 stocks that have done extremely well, that are up year to date, some of them up 40-50%. And in that context, we are trying to look for high quality blue chip names which have lagged that basket. And one of the names that stand out is Maple Tree Commercial Trust. As we all know, it's a blue chip name under the Mapletree Group. It owns some of the best assets in Singapore. It has been hit because of the exposure to the mall side of things with VivoCity, and especially as that mall serves as the gateway for tourists into Sentosa. If you look at the performance, the stock is down about 20% from the highs that was registered, and it has significantly underperformed the likes of Ascender Street, Mapletree Industrial Trust, and Mapletree Logistics Trust, which are the other blue chip names in this sector. But despite all of this, at this point in time, the stock offers about 4+% dividend yield. And given that a lot of the concerns around this pain point of retail is already in the price, we think that this is a great play on the normalization of the economy, especially around the COVID-19 issues, and as the worst around the dividend cuts seem to be behind us. So that would be, one of the ideas specifically in the Sing REIT space that we think investors should look at. If you flip to the next slide, associated with, continuing on with that same theme, we have a name in Hong Kong, which is Link REIT, the largest REIT in Hong Kong, and not only the largest in Hong Kong, but also one of the largest REITs in the whole Asia Pac region, including Japan and Australia. This stock started correcting a lot earlier because it was not only affected by the COVID-19 issues, but also around the uncertainty in Hong Kong, given the the political situation there. And the stock is down close to 40% from the highs that was registered in the mid-2019 period. The stock trades at 0.8 times book. And if you go back and look at, since history, since the listing of this stock, the stock has never traded at these levels. The dividend yield of 4.5 is also one of the highest that this stock has traded at. Clearly, Hong Kong retail exposure has been the pain point for this stock. But again, similar to what I mentioned with regards to Mapletree Commercial Trust, it is really very well placed to benefit from any normalization on that COVID-19 situation. The last stock that I want to highlight again, if you flip to the next slide, it's really a more generic, integrated property company, property developer in Hong Kong. One of the go-to names in that space, blue chip names, which many investors like. It has been beaten down again, very similar to Link, not only around COVID-19 issues, but also around the uncertainty, around protests and the political situation in Hong Kong. 30% of the highs that was registered, and the stock trades at 0.5 times book. This is the cheapest it has traded in the last 25 years, and it offers a dividend yield of about 5%. Now, the diversified exposure to various sorts of income, including retail income, suggests that they their cash flows are fairly secure, and at the same time they are well leveraged to benefit from any reversion in the economy as the situation around COVID-19 sort of normalizes. So in the real estate space, which has been a laggard sector, I think these are three very high conviction ideas that we have that we feel investors should look at right now.
Well, thank you, Pratik. I think, Pratik, thanks for your presentation. I think you'll still be around for the panel, but I want to bring right now Alex into the conversation, and also for Alex to really pin the technology landscape for us, and especially when it comes to big tech, because big tech has done extremely well. So, Alex, what's your take on the current landscape in the technology space?
Yeah, thanks, James. In my conversations with clients almost on a daily basis, not a day goes past without a discussion of these five names. Yeah, Google, Apple, Facebook, Amazon, Microsoft. I think it's been an outstanding performer in the course of this year, and especially we saw a heavy acceleration after the March sell-offs. If I can move on to the next slide. We have some, so this displays the outperformance. And if you look at this slide, even Google, which is clearly the laggard performer, is actually outperforming the S&P 500 index almost on the double basis. Yeah, next slide, please. So when we look at the big tech, we have made some observations. And of course, if you are been following up on the news, everybody talks about acceleration of big tech. And the numbers that they've thrown up has a range between 2 to 5 years ahead, pricing in the growth. And if you look at IBM's recent US retail index, the pandemic has actually accelerated the shift away from physical stores to digital shopping by almost 5 years. So across the road, if you look at in terms of the rally has been very fierce, has been extremely aggressive. But what you need to also bear in mind is that the market is trying to price in 2 to 5 years of growth ahead. So while this is making people very uncomfortable, but you need to bear in mind that within the entire various economic sectors, these big tech sectors are the ones that has obviously demonstrated the success of their current growth. And if you put forward into the next 5 years, these are the ones that will continue to display this style of growth. So on this basis, sorry, can you move back to the last slide? So on this basis, there's concerns on whether this is sustainable in this current rally. I think no one is absolutely confident, but what we have seen in investor flows, both from institutional and retail investors, inflows has been very robust. And of course, if you look at analysts across the street, most are generally still positive, but you will notice that they have been talking about the valuations being stretched, and they sound very cautious on valuations. Now, that's something that has always been discussed for technology stocks for the last few years. I think it's nothing new. It's just that people are a bit more concerned now on stratospheric valuations. Now, if I also look at big tech stocks from another perspective, most of them are having actually a mega cap status. The market capitalization, for example, even for the smallest name in Facebook, the market cap is just hovering close to 850 billion. Now, obviously, the largest cap would be Apple, which is already trading at about 2.3, 2.4 trillion market cap. Now, this market capitalization is something that we have not seen before. But if you think about it, the business model in big tech, clearly there is earnings growth. Clearly, they were big in the first place. But now, because of this big inflows into these 5, 6 names here, now they're having a trillion market cap right now. And this actually enhances their defensiveness. Because if you think about it, a company that is a tech company that's possibly trading at 10 billion compared to Apple, which is trading at 2.3, 2.4 trillion, how likely is it for Apple to trade down 20%, considering its market cap, as opposed to another company with a 10 billion market cap? So for names like big tech, I think it is hard to see a very strong sell-off. So the mega cap status allocated to these five stocks actually enhances their defensiveness. I think their business model is quite clear. It's working now. It will continue to work in the next 3 to 5 years ahead. And of course, there's broader street support from both institutional and retail investors. So moving on to the next slide. And then the question naturally goes to, is it time to profit take? This is a question I have it every day. I think if you look at a broader trend, both from a price point, both from a sentiment perspective, I think it is very hard to call for profit taking. Yeah, I observed that for a lot of companies that try to impose a very negative view on these companies, they get punished, because you may say that Apple is expensive 3 months ago, but 3 months from then it has rallied a further 20 to 30%, and it is still expensive. So for people who takes say a negative view, citing the basis of stratospheric valuations, I think it's not a very good recommendation at this point to call for profit taking. So then the question naturally gravitates towards should you continue to buy? Should you continue to hold? Should you continue to sell? Now, this is a very big question here, because it varies from clients to clients, right? For clients that is already invested 1 year, 3 years, 5 years, or even 10 years ago, now the natural tendency is to hold on to your winners, and we encourage you to hold it, because the price trend is supportive of all these names. Now, if asking you clients to take a new position on these names, now it is quite difficult, because our everyday conversation with clients show quite a big amount of hesitancy in initiating fresh positions. So what we do is we actually recommend a piecemeal buying approach, right? And on this basis, should you sell the stock? I think, as I mentioned, it varies from client to client. I think the portfolio rebalancing is an important part of the exercise that one should look at whenever you talk about buy, hold, or sell on certain stocks. So in this case, if you have it, you hold it. But if you think that, for example, you're holding on to Apple, right, and you are probably sitting on at least 50 to 100% of profit takings on Apple, and you're feeling uncomfortable. And of course, we know that Apple has rallied 70% this year, and looking forward into next year, does it make sense for a 2.3, 2.4 trillion cap company to continue the strength of its 70% rally this year? I think it is not realistic to have that high expectations. So on this basis, if you are uncomfortable, then you could rebalance your portfolio either through top slicing a position. So for example, you have a 100,000 position in Apple, it has rallied to 150,000. Then going into next year, you are feeling uncomfortable. Perhaps it's not a bad idea to consider trimming your positions and rebalance it to the original 100,000 position that you originally had in Apple. So this varies from client to client. Yeah.
Well, thank you, Alex, for your insights on the technology sector. And related to that, e-commerce. E-commerce is something that has accelerated because of COVID-19. In fact, all of us, because of the lockdown, made our purchases, etc., online, digitally, mobile. So the big players, of course, we all know, is Alibaba in China and Amazon in the US. And I think a lot of our investors have holdings in these two stocks. Are there other companies that can actually benefit from the trend of e-commerce?
Yes, James, James, thank you for the question. It's a very valid question. So if you talk about e-commerce, these are bread and butter names in Amazon and Alibaba. And frequently we get a lot of questions on what other names can I look at it on from a global e-commerce perspective. And closer to home, I think the first name that we need to look at, because we're in Southeast Asia, right? The first thing to look at must be naturally SEA. So SEA Limited is a name that people are not that familiar, but if I mention Shopee, I think most of us would be very familiar because most of us have done some form of shopping on Shopee probably in the last 6 months or so. And if you remember, last year, Ronaldo, when he visited Singapore, he actually said in an advertisement that he featured in for Shopee. So Shopee is a name I particularly like because it's close to home. It's been hyped as the Tencent and Alibaba of Southeast Asia. And indeed, if you look at the entire ASEAN space, there is no single e-commerce name that looks like it. It resembles its business model that has been able to generate the type of exciting hypes in recent months or recent years in space. So on this basis, I think if you're looking at e-commerce space for ASEAN, Shopee is the one, SEA is the one that you need to look at. It's not only the #1 play on e-commerce, having overtaken Lazada in recent months. I think if you look at it from investor interest perspective, Southeast Asia is a very big market after China, after US, and Southeast Asia is something very interesting. And SEA makes it even more interesting because it is the only one and listed play in e-commerce for ASEAN. So on that perspective, I think you should take a look at SEA. It's Tencent backed. I think the fantastic thing about SEA is that it is despite a 3-year laggard in terms of setup behind Lazada, it has overtaken Lazada in terms of e-commerce matrix like GMV, gross merchandise value. The only concern that most people have with SEA is that they have no profitability yet. But I would like to share, back many years when Amazon first came into the scene, it took them a good 6 to 7 years before they actually generated profits. So I think people, when you look at SEA, you should not be too overly concerned with the lack of profitability. I think it will come on a growth matrix. It's outperforming. Yeah. So that's a name that you should look at for Southeast Asia. And if you look at e-commerce into other sectors, next slide, please. And I think everybody talks about China. You always talk about Alibaba, but a lot of people don't really focus on the #2 e-commerce play in China, which is actually JD.com, Dingdong. So this company is been frequently people always get confused between Alibaba and JD.com. Now, in short, JD.com, they are both e-commerce plays, But the difference is that Alibaba has always operated on an asset-light model, whereas JD actually operates on owning assets. So JD owns the entire supply chain that powers down to delivery, to hiring the deliverers, to owning the warehouses that store the e-commerce goods. So that supply chain has been something that JD differentiates itself from Alibaba. Now, when you talk about JD, you always talk about growth, just as you talk about Alibaba. But JD being the much smaller player, despite being ranked number 2, actually, you have to look at it from a strong growth basis, and we are talking about growth in the plus 20, 25% type of growth year after year, and they have it. A problem that JD used to suffer in the past is they used to suffer from margin compression, and that is because they were trying to build up their supply chain capability through buying more warehouses, through hiring more lorries to transport the e-commerce goods, etc., etc. That was a problem that used to plague them in the last 18 to 24 months. But this year, I think that problem that has been a stock price drag, that is firmly in the past. And I think JD.com also has a very strong balance sheet. That is something that you cannot take away from them. But I think in the current context, where C19 is still plaguing the entire world, of course, when we know when it hits China, delivery capabilities was very much stifled. I think even Alibaba fell victim to delivering the goods that they were meant to do so. But the JD.com was able to rapidly summon up the entire supply chain capabilities that it has at its disposal. And in a short space of 2 to 3 days, post-breakout in China, they were able to resume the e-commerce capability through delivering the goods, essential goods to people who are still stuck in the lockdown. So I think this C19 pandemic actually displays the strength of the JD operating model, where they own the entire supply chain assets. So if I may cut the short on JD.com, I think other catalysts you want to look at is, first of all, they are having potential IPO in some of their units. For example, JD Logistics, JD Health, JD Supermarket, and I want to stress that JD Supermarket is now China's largest supermarket. So that is a very big deal because China is a big market. And of course, they're currently in the process of filing for JD Digits, which used to be known as JD Finance. Now, if you understand, recently there's been a lot of hype on Alibaba's Ant Financial's IPO. JD Digits is the equivalent of Ant Financial in China. All right. So I think these are various catalysts, both from a fundamental and near-term catalyst that can propel JD nearer term. Next slide. Next slide, please. And the last thing I would like to talk about, next slide, please. Last thing I would like to talk about e-commerce space is to be focused on Latin America. Now, Latin America is quite similar to ASEAN. We have a population of around 640 to 660 million. So ASEAN and Latin America are comparable when it comes to the addressable market in terms of e-commerce. Now, Mercado Libre is Latin America's #1 play on e-commerce. Now, this is a very interesting name here. Most clients are not very aware that Latin America actually has their own e-commerce capability as well. And then the strongest one that has the most established ecosystem in terms of e-commerce, in terms of supply chain capability, in terms of digital payments, the most established is Mercado Libre. All right. So this is a name that you need to look at when it comes to Latin America e-commerce. I would argue that Mercado Libre is the Amazons of Latin America. They not only are going on asset light, but they also, just like Amazon, own the entire supply chains of a delivery in terms of warehouses, etc., etc. So I think given what we saw, Amazon taking the world by storm in terms of having this capability, I think Mercado Libre is set to do very well in the Latin space where this capability is concerned. Yeah, can I move on to the next slide?
Alex, you talked about sharing economy, right? So ride-hailing. So what's the impact of COVID-19 on this sector? And also, more importantly, is there any stock there that could be affected, or it's an opportunity?
Yes, thanks, James. So if you look at ride-hailing, it's one of the most heavily hammered sectors in the world. If you look at Grab in our local space, practically there's a lot of drivers out there, but no one is taking it. And even as I speak right now, they are still feeling the impact from this C-19 pandemic. So I can move on to the next slide, please. Next. So I think on this respect, if you talk about Grab, I think we look at in terms of ride-hailing, you need to look at the world's #1 play on this business, and that is Uber. I think Uber went through a very bad patch last year because of a drag from SoftBank on that basis. But I think this business still remains sustainable into the next 3 to 5 years post COVID-19. Yeah, and a lot of questions has been asked. The difference between Lyft and Uber, and I would argue that Lyft is just focused on the local context in America, while Uber is a reflection of the global demand for ride-hailing on this basis. I think you need to keep this on your mind, because for Uber, while it has been affected by SoftBank, I mentioned earlier, and of course COVID-19, I think there are two things that you need to look at Uber. The first thing is that Uber has been aggressively investing into autonomous vehicles, and that is very important here, because roughly 70 to 80% of costs associated with ride-hailing actually boils down to drivers. And since in the last 3 to 4 years, Uber has been investing heavily to develop the autonomous vehicle capabilities, which suffered a setback when they had a fatal accident back in Arizona, probably in the start of last year. But I think given that there's a lot of hype about autonomous delivery, recall yesterday Amazon talked about delivering their goods using drones. So this concept is already here. It is here to stay. I think autonomous vehicles will be a very big part of Uber's profit capability, probably in the next 2 to 3 years ahead. And one part that the market ignores about Uber is it has actually a business that is Uber Eats. And we know in the local context, Uber Eats merged with Grab to form Grab Foods, right? But Uber still owns a share in this business. And of course, if you look at the entire COVID-19 pandemic, delivery has been a very key part to maintaining a part of our lives, especially in the part of food delivery, where groceries is concerned, where essentials are concerned. I think Uber Eats provides a free optionality, and the reason I say it's a free optionality is that the whole world seems to forget that Uber actually has this food delivery unit that has picked up in recent months, and its valuations has also been greatly lifted in the last 6 months. And I expect the valuation of Uber Eats will continue to expand, and that will provide a basis for Uber's price and valuation support in the coming 2 to 3 years ahead. Yeah.
So Alex, I think in terms of fintech and the payment situation, so how do you play that in the fintech space?
If I may go on to the next slide. So on the fintech space, I think, next slide, please. Next slide. Yeah, I think in the fintech space, everybody always associate names with MasterCard, with Visa, with PayPal. I think these are names that most investors are relatively very familiar with. But I think there are other fintech plays that has already been listed that ought to be considered. And I think in the US, I think there has been a lot of interest in fintech plays, particularly after Visa bought over a fintech play for the cost of US 5.1 billion earlier this year. Now that has led a lot of interest into the smaller fintech plays that is currently listed, and one of it is Square. I think Square is a platform, is a payments platform. But at the same time, I think it is rapidly building up is an ecosystem by the capability of this application called Cash App. Now, Cash App is like all-in-one application whereby you can do delivery, you can do facilitate your cash transfers, you can actually transfer money here and there or on a global basis, and it's very popular in the US, particularly because the platform itself actually allows you to do fractional stock investing. So what is fractional stock investing? It's very interesting. So for example, prior to Apple's stock split that just occurred recently, is as absolute amount, it is very expensive for a single stock. But what Square can do is that they can actually unitize one single stock of Apple, split it up, and then sell it to it's a retail investors that has downloaded its application. And this fractional stock investing is kicking the world by storm, because you would have read about Robinhood that is gaining in popularity in the US. Square is also capturing this trend. In fact, I would consider it one of the pioneers in fractional stock investing. And that is very important here, because it generates a lot, it increases the stickiness of a young investors that is actually going heavily into fractional stock investing. And the other thing is that Square actually also built up a capability in the settlement of cryptocurrencies. And of course, we know, cryptocurrencies that is been focused on blockchain technology has been all the way in the last 3 years. And of course, Bitcoin at one point rallied to over 20,000. That was just 2 years ago. There's a lot of interest in cryptocurrencies and digital coins trading among the younger investment generation these days. And actually, Square is capturing this trend. And so I think there's something very interesting, because not many houses, listed companies actually have this capability in looking at a company from a cryptocurrency perspective. I think Square, aided by its Cash App application, I think they are in a pole position to capture this trend towards retail investing in fintech, in terms of digital coin settlements, etc. So one name that you want to look at for fintech in the US, I think Square would be my topmost recommendation in this space. Yeah.
Well, thank you, Alex, for your insights and sharing. I think right now we want to move into the Q&A, because there is a lot of food for thought in terms of the three-pronged strategy and how all these fits into clients' portfolios. But first up, I think I want to take on as many questions as possible as those that you have asked. And I want to tap on Pratik and Alex on how to go about it. But I want to urge, because in light of timing, everyone to keep your answers as short as possible, if we can, answer in 30 seconds or so. So first question, risk of inflation on the economy, and if there's too much global stimulus at the end of it. First up, I think I'll answer that. I think my simple answer is that inflation risk is extremely low. And that's why the Federal Reserve are allowing this new average inflation targeting regime. Because over the last 10 or even 30 years, they have been always undershooting the inflation target. And of course, with this whole global pandemic, what it creates is that it's a demand and supply shock at the same time, which is actually extremely deflationary in many respects. So you have 30 years of deflationary, even without global pandemic, and you add that global pandemic. Therefore, I think, in my view, at least in the next 1-2 years, inflation risk is extremely low. Next question, I think I want to tap on Pratik. Pratik, you mentioned about REITs. But you did not talk much about property developers. So would you want to comment a little bit on that?
Yes. So basically, James, the property developer model has evolved. And if you look at the integrated developers that probably you are referring to, you have a mix of residential developments as well as commercial developments in there. As in completed commercial assets in there. Now, a REIT is a much more tax-efficient way of holding those commercial assets. If you have it through a developer, you are subjected to taxes that you pay on the earnings. The only reason in the past to buy developers has been for the residential component. Now, what we've seen across many markets in Asia and even globally is that the regulators have come down very hard on the residential market in terms of policies, where they've made it very difficult for developers to earn a meaningful profit on that development business. That is one of the major reasons why that interest has shifted away from developers and into REITs. In fact, if you look at markets like the US or in Europe, you don't have these integrated developer models anymore. You have pure play REITs, and then you have home builders. And lastly, it is absolutely correct that this is a sector that offers value, but we want to be very selective when we even look at these value opportunities. So amongst the three names that I mentioned in the property space, Sun Hung Kai is actually an integrated developer. So you can look at that. It is cheap, trading at 0.5 times book. We just want to be very selective in that space as well. And Sun Hung Kai is one of the best names to get exposure, if you're looking at developers specifically.
Oh, thank you, Pratik. We got one question on autonomous transportation. Can it get out of the lab without a fully enabled 5G infrastructure? My answer is no. You really need 5G to make all these things work. Because what 5G does is not just fast. What it does is it reduces latency. And of course, in autonomous driving, you need the two machines or various machines to talk to each other, and you can't afford any lag. So therefore, I think 5G is crucial for the implementation of autonomous driving. So I think we can clear that question. And I think we have another question, I think, for Pratik. What's your view on European versus US banks? And on balance, where do you see better value?
Yeah, so basically, if you look at the valuation simplistically in terms of price to book multiples, then the European banks obviously offer more value. But obviously, that also comes at significantly higher risk. So the way we are looking at this, approaching the strategy on a three-pronged basis is, selectively look at, laggards in a very calibrated fashion, because as Alex mentioned, I think, there are still many opportunities on the structural growth side. So we don't want to completely abandon structural growth and go all in on value. We want to selectively move in and out. So on that basis, we are really looking at high quality names. And if you want to look very specifically at Europe, then there could be banks like Crédit Agricole and BNP that you might want to consider. But comparing between US banks and European banks on a risk-adjusted basis, we feel the opportunities are better on the US side of things.
Well, thank you, Pratik. And I think the last question, goes to Alex, and it's on technology, basically about positioning your technology positions. And the question is that given that US tech is extremely stretched in terms of valuation, do you think it's a good strategy to swap US tech stocks to China tech? And also related to that, if you do get pullbacks in the big tech, is it a time to acquire? So I think that question for you, Alex.
I think in terms of technology progress between the two countries, it's really very different. China has been very creative, spending a lot of R&Ds in terms at the country level and at a single country level compared to those in the US. So I don't think you want to have a situation whereby you accept the US technology stocks and you completely ignore China's technology stocks, because at the country level, both are different. I think both have scope to grow. The world has enough space to accommodate the two technology companies of the two countries. I think you shouldn't ignore one or the other. And the next question is, sorry, James, I didn't catch it. Is
if you get a pullback in the big technology companies, 20% or whatsoever, is it time to buy?
I think in my when I mentioned big tech earlier, I think given that they have a mega cap status, I'm not expecting a big pullback. A big pullback defined as 20%. I don't think we will see that again. But in the case where we see a smaller sell-off, like 5 to 10%, even if it even goes down to that level in the first place, I think it's good idea to continue to pick up on these ideas. Because if you recall in one of Pratik's slides mentioned earlier, there has been a gravitation of weightings in the equity indices, whereby a lot of sectors have seen outflows that has been moving towards tech sector in the last 10 years. Now, this acceleration in the last 6 months is actually something that we expected over the last 10 years, but it has accelerated within a very short time. So I think if you look in terms of forward growth, other sectors, say banking sector or consumer staple sector, they are unlikely to generate as much growth in the big tech sector. So I think you should buy all these big tech names whenever there is a selling off. Of course, at what price points, I think we can take it at an individual level.
Well, thank you, Alex. Really, We've come to the end of our Q&A section, and I'm sure we still have many questions unanswered, but we will tend to it through your RMs that we will provide you that answer. So with that, I'll hand the time back to Sam to give us a closing for this very, very exciting equities webinar.
Thank you, James. Thank you, Patrick, and thank you, Alex, for your wonderful sharing here. And just as James said, due to the time, I'm sure you have so many questions, and unfortunately, we cannot answer every one of them. And please reach out to your relationship managers, and we are very happy to answer your questions with the follow-ups. And we hope that through today's webinar, you would really regard HSBC Private Banking as your partner of choice for equity investment. And finally, please allow me to make a very small advertisement for our next webinar, which will be hosted on the 8th of September at 3 p.m. And the topic will be another exciting topic, which is fixed income opportunities in the zero-rate world. Again, I hope you can join us again in the next webinar. We wish you a very nice rest of the week, and thank you for your time today, and happy trading. Bye-bye.